All right, let's jump right in. We're going to talk about something kind of wild today. It's a story about one company, a couple of headlines, and a stock market jump that is so huge it's hard to even wrap your head around. Yep, we're talking about Oracle, AI, and a number that really makes you stop and ask, wait, what is actually going on here? So here it is, $240 billion. That's not the company's total value. That's how much its value went up in one day. I mean, to put that in perspective for you, that's more than the entire yearly GDP of Greece, the whole country. Added to Oracle's value basically overnight, all because of some AI contract news. The big question is, how is that even possible? And that really gets to the heart of it, doesn't it? This quote just nails it. To make the math work for a number that big, you basically have to ignore the rules of Finance 101. You have to pretend you're in some kind of fantasy world where risk just, poof, doesn't exist. And that's exactly what we're going to unpack here. So let's think about this like a giant puzzle. You've got these pieces, AI contracts, a ton of market hype, financial models, and we need to figure out how they all fit together to create this incredible $240 billion picture. This is really the core question, right? How on earth do you justify a leap that big? Because when you start digging into the numbers, you find there are two completely different ways to look at it, and they give you two wildly different answers. So this table kind of lays it all out. On one side, you've got what we'll call sober finance. You take Oracle's new AI deals, let's say they're worth about $15 billion a year, and you apply a normal discount rate, something between 8 and 12% that accounts for the real cost and risk of doing business. The outcome? It's good, it's solid, but it's not world-changing. But then, you've got bubble math. Here, you just slash that discount rate to under 5%, and boom, the valuation explodes into that $240 billion figure we saw. Okay, so let's dig into that gap, because it's everything. It has a name, and it explains not just what's happening with Oracle, but a whole lot of the craziness we're seeing in the market right now. It's called the cost of capital chasm. So here's the deal. The cost of capital chasm is this giant, dangerous gulf between a valuation based in reality and one based on pure speculation. It's what happens when investors just decide that the normal rules about risks and reward don't apply anymore, just because a shiny new technology is involved. Look at it this way. On the left, that discount rate reflects the real world with all its messiness and uncertainty. On the right, you've got a rate that basically pretends these massive, complicated AI projects are as safe as a government bond. That tiny difference in percentage points, that is the chasm, and deciding to leap across it is how you get a $240 billion jump. But what could possibly justify that leap? Well, the justification seems to come from a really powerful, but honestly a deeply flawed analogy. You see, investors are starting to treat these huge AI contracts like there's something else entirely, something much safer, much more predictable, and from a totally different era. Believe it or not, investors are acting like Oracle's AI deals are the new railroads of the 19th century. Think about it. Railroads had hard assets, right? Steel tracks, land, predictable ticket sales for decades. But AI contracts, they are the opposite. They're intangible, they're incredibly complex, and as you're about to see, they are just loaded with risk. And this is just scratching the surface of those risks. You've got operational risk. Can Oracle actually pull this off at scale? Logistical risk. Data centers, chips, power grids, they don't just appear out of nowhere. There's huge engineering risk in trying to make this new tech with old systems. Execution risk. If it's not perfect, clients will walk. And of course, the big one, massive regulatory risk from governments all around the world. So when you look at that giant list of very real, very expensive risks, and then you try to apply a discount rate under 5%, well, you're not really doing a financial calculation anymore. It's wishful thinking. It's storytelling. You're basically writing fan fiction about a perfect world where absolutely nothing can go wrong. And here's the really scary part. We've seen this movie before. This isn't some new genius strategy. It's the same old playbook that shows up again and again throughout market history. Whenever a new, exciting technology comes along, the first rule to get tossed out the window is the one about risk. I mean, look at this pattern. It's uncanny. Back in 1999 with the dot-com bubble, investors were valuing companies based on eyeballs and using tiny discount rates. Fast forward to 2017, and crypto networks were being valued with discount rates that were basically zero. And here we are now, in the middle of the AI hype, watching people value complex service contracts as if they're as safe as risk-free government bonds. It's the same story, just a different main character. This quote just perfectly sums up that whole cycle of mania and, well, correction, the market gets super excited, throws out the textbook, and then reality comes crashing back in. The crash is always a painful reminder that those boring fundamental principles of finance, risk and return, they actually do matter. A lot. So, this all brings us to the final and most important takeaway. What happens when the fantasy starts to fade? What happens when the market stops ignoring all that risk and starts actually pricing it back in? Well, that's when this chasm we've been talking about becomes something much, much more dangerous. And let's be super clear about this. The point here isn't to say that AI is fake or that it's not going to be a huge deal. It is, and it will be. The problem is the valuation. The problem is watching investors leap across that chasm by pretending that all the very real, very expensive operational, technical, and regulatory risks just don't exist. And that's really the thought I want to leave you with. Risk never actually goes away for good. It just hides for a while. And when it comes roaring back, because it always, always does, that wide, tempting chasm between sober finance and bubble math doesn't just disappear. It turns into a cliff. And the fall from there can be a very, very long way down.